In this video, traders, I want to look at the differences between futures and CFDs. Stay tuned. Hey guys, warm welcome to you guys. This is a question that came up a while ago. Actually, I don't think I addressed this. I may have done a video about this before, but it's worth covering again. If you are kind of getting into trading, maybe you've gone down one avenue or the other and you're going, oh, should I be trading futures? Should I be trading CFDs? I would add spread betting to the mix. Spread betting is effectively a CFD, but in a tax-free wrapper or a tax-efficient wrapper for UK clients. You can go check out a video on that if you want to look at the difference. This probably applies to more people across Europe. Unfortunately, CFDs aren't available in the US. Are they available? I think they're unregulated, so you probably could get bypass it somehow, although no kind of legitimate CFD broker will allow you to open an account if you're a US resident, so you're stuck with futures. Not as a bad thing, but let's look at the differences anyway. So if you're a European and other places, you're probably going to go, right, which is the best one for me? So look at the pros and cons and what each does. So think of the big thing is that futures contract sizes are fixed, right? So you've got a fixed contract size. If you're trading the Dow, which is the YM, it's going to be $5 a point. And so if you're trading crude oil, $10 a point. So every kind of ticket moves, that's how much you're going to win or lose, depending for long or short for one contract. Now they do micro products, which are a tenth of those. So you do have that option, but you don't have the kind of granularity adjustment contract sizes that you do when you're trading CFDs. Now CFD generally, and it does depend, this is kind of, there's not a generalization. I mean, there's no kind of normalization, if you like, of contracts. Some brokers say one contract is £1 movement. Some brokers say one contract is £10. You need to go on the demo and work it out and see. But you can, most of the time, you can trade down to kind of 10p a point, or 10 euros, 10 cents, $10, 10 cents in dollars, 10 euro cents. You can kind of really trade a small amount so that you can test your strategies. You can have some adjustment where you can scale out the trade. And so that's one of the big things I think that with CFD trading you don't get with futures, is that you do have the option to really trade small and live. Futures, even if you're trading a kind of a micro contract on some stuff now, that's still quite a lot for new traders to really moving around. And then if you want to try and scale as well, you have the opportunity. So that's one of the advantages I think with CFDs, is the ability to kind of really be granular and go down the contract size. So flexibility, futures and CFDs, so you can really play a good game with CFDs in that, okay, futures, you are restricted to futures that are trading on an exchange. Generally speaking, you have to subscribe to that feed to get a live futures feed. So you have to subscribe to CME, or you have to subscribe to ICE, or whatever it is you're trading on, and different futures contracts are trading on different exchanges. And so if you want everything, you have to subscribe to all of these. Now, most brokers who are offering CFDs, they don't charge you a fee to have the platform, and you're going to get a CFD feed for everything from whatever they offer. Whether it's a CFD on some of the US indices, the European indices, whether it's a CFD on commodities, energy, grains, softs, maybe they offer some meats, but the idea is that you can get access to everything. So you've got a lot more flexibility there of how you want to trade. Margin, generally speaking, CFD margin is much more generous, and that's not always the case, because futures margin is determined by the exchange for overnight. I.e., if you're holding a contract overnight, you have to have this amount of margin in your account no matter what. Now, intraday margin, some brokers offer a very low intraday margin. The way they get around that is they kind of shuffle around who's owning the contract and they put up the rest of it. And if you're closing it out before the end of the day, they're happy for you to put up like $500 or something for a mini contract. So there's not quite as clear cut that, but generally speaking, if we look at it generally, brokers are more, and okay, with ESMA rules, they're slightly restricted in terms of how much margin they can give you for a CFD contract, but it's still reasonably generous. In other words, you can control quite a lot of notional capital with quite a bit of small actual capital. And if you want to check out more on margin, I've done a video where I've gone into margin and leverage and the impact of that. Spreads and charges. So spreads and charges are, well, the spreads are fixed for a futures contract. That's fixed by the exchange. So the tightest spread, let's say on the Dow, is 1 point. If we go to the S&P, it's going to be a quarter. So you can't get any less than that. Whereas if you go into CFDs, sometimes the spread will be tighter. Actually, there's some products out there, they want you to trade them. They're even a tighter spread on the CFD than they are on the actual exchange, just because they're just taking order flow from both sides and being a kind of middleman for that. Sometimes there are commissions on top of the CFDs, sometimes they're wrapped into the price, depends who you're trading with and how you're trading. Futures always have a commission on top, so you pay the spread if you cross the spread, that is, and you pay a commission as well. Now, the one advantage with futures that you don't get with CFDs is that you can make a market. So you have direct access into the order book. So if you go on the bid of the futures contract, you might get hit by somebody. You're basically making the spread then. You don't get to that with CFDs because you're trading, the other counterparty, your trade as a broker rather than another market participant, which is in the futures world. In the futures world, the exchange acts as an exchange and participants come in, and your counterparty is your trade as another participant, whether that's a bank who you're one of several thousand contracts he's done that day, or whether you are an individual trader and she's just lifted your offer or hit your bid. So that's where it's slightly different. So you do have that advantage if you've got a very, very active strategy. Country, yeah, futures, I'm pretty sure most countries allow you to open a future. If you can get a broker, account, then I'm pretty sure you can access futures from most countries. And so you just open a broker account, you sign up for the data feed, you tick a few boxes, you go through a few hoops, and you're away. CFDs, they're restricted in certain jurisdictions. Like I said, in the US, I don't think they're not regulated, I believe, in the US. Now, listen, I might be talking nonsense here. I don't live in the US, I don't know the ins and outs of it. As far as I'm aware, I know that a lot of brokers who offer CFDs in Europe don't offer them to US clients for a reason. Now, is there someone who does? Maybe there is, but I don't think they're allowed to promote that to US clients. Expiry, big thing with futures versus CFDs is futures have an expiry date. You're basically buying an expiry. If you're buying a March contract, that will expire. So in other words, the difference in that, at the end of March, it will expire, and you either have to close it before it expires, or you will end up converting that futures contract into the underlying, which if you're buying a basket, if you're buying the Dow, for example, that will then be converted into the basket of shares. If you're buying a contract of crude oil, for example, that's going to be converted into your barrels of crude oil. Now, okay, most retail brokers won't let you take delivery, as it's called, of the contract. They will automatically shut it off before then. But theoretically, that's what they're there for, right? You buy crude oil contracts, futures, and then it basically says in March, let's say you buy it for $80, right? You buy one futures contract and it says that in March, I'm going to have this price, $80, I'm going to pay this for the crude oil delivery. And the idea is that if you consume crude oil, not consume it as in consume it, if you used it for whatever reason, see some manufacturer or something, or some sort of cracking industry, you would guarantee that price, and so you would get delivery of that crude oil depending on a contract you bought at that point. I guarantee that price that you paid. If the price is lower, you still got to pay the higher price, but you're guaranteeing that delivery. And if you hold it through to expiry and through to delivery, that's what happens. Now, retail traders, we don't want that, right? We don't want our dries being filled up with corn or crude oil or orange juice, or even taking delivery of basket of stocks, right? We just want to trade the oscillations. So most futures brokers won't let you hold it right to the end, but it's still, when you get to the expiry, you still have to change and go to the next one if you want to hold the position. So you'll constantly be aware of what's the front month, it's called, where the most volume is, and then shift that over when you come towards the end of that expiry. So there's a little nuance. It doesn't happen very often. There's a little nuance to remember. CFDs, you've got no expiry. Generally speaking, it just keeps rolling and rolling, and you get charged a little bit every day you hold the instrument, and you kind of can hold it indefinitely. It's a good short-term instrument. It's not so good for kind of long-term. Futures is a little bit different in terms of it's kind of baked into the price of the futures contract against the underlying at the point in time. Sometimes there's a premium or discount depending on which way we're looking at it, and ultimately that comes back into line at expiry. Again, that's something more topic to dig into. I've done a video on that exclusively if you want to look about that. No delivery, talked about that. CFDs, you don't get any delivery of the product, which futures contract you effectively could. And there's more markets. Someone might call me out on this and go, that's not true, Mark, that's not true. But I think CFDs, generally you can trade more things than you can futures. Why do I say that? Because you can trade all the futures contract via CFDs, but CFD also allow you to trade, most brokers allow you to trade CFDs on some equities. So you can trade a CFD on something like Tesla, on Facebook, maybe an ETF. Sometimes they create synthetic baskets for you and say there's a tech basket or stuff. So I'm saying this carefully and cautiously, but I think generally CFDs have more markets. So, you know, there's pros and cons to both. I think personally, if you are in a jurisdiction where CFDs are allowed, it's a good place to look. I think you'd have to have a compelling reason to trade futures, especially now when the spreads are so tight, and if you're trading actively intraday and you're getting good fills and all the other stuff that got to be a given, you're probably going to be better off trading CFDs. That's a generalization. Obviously, I'm not recommending you do anything. You've got to do your own homework, but I think generally for most people, that's probably the way to go if you're allowed to in your jurisdiction. But there's nothing wrong with futures. It's close. It's not like it's clear cut, but it's close. But there you go. Futures versus CFDs. Take care. Bye-bye.